Understanding negative gearing. Lots of people ask what negative gearing is. So to put it simply, negative gearing is where you borrow to invest. That's the gearing, but the income that you earn from the investment is less than what it costs you to hold the investment, which creates a loss. That's the negative part. So why would you want to negative gear? Well, in some circumstances, the Australian Tax Office lets you claim the loss you incur against your other taxable income. This means that you get an overall tax reduction because you have negative geared. In effect, the ATO is helping you to purchase the asset, and this makes the investment more attractive as it's less cash out of your pocket. Gearing also gives you leverage. That is, it makes your money work harder for you by giving you greater exposure to movements in the markets. For example, if you had $1,000 to invest and the market improved by 10%, you would have made $100. However, if you had $100,000 to invest and the market improved by 10%, then you would have made $10,000. This is leveraging. But don't forget that the greater exposure goes both ways, meaning you can lose more too. So what can you negative gear? Property is usually the most common investment that is negatively geared, and this is usually what people are talking about when you hear them talking negative gearing. You can also negative gear direct shares or managed funds. This is often referred to as margin lending. The lender decides how much margin they are willing to lend against and calculates the market value of the shares or funds regularly to ensure that you are still in your margin. If you go over your margin, they typically will require you to either sell some of your assets so you're back within your limit, or pay them some money so that you return to your limit. This is referred to as a margin call. For this presentation though, we will focus on property. So how does negative gearing work? Let's run through a simple example. Say you borrow $400,000 to purchase a rental property. You receive $20,000 rent for the year, pay $24,000 in interest and another $3,000 in other costs such as rates, insurance and agent fees. So in total, it's cost you $27,000 to own the property. Your net loss is $7,000. That's $20,000 less $24,000 less $3,000. This net loss is used to reduce your other taxable income. So assuming you're on the 34.5% tax bracket, including Medicare levy, that's a saving of $2,415, meaning that the after-tax cost of owning the property for the year was $4,585. That probably all seems too good to be true, so there are a few other things you need to consider when making a decision to negative gear. Firstly, we suggest that you consider the investment over its lifetime. That is, don't just focus on the year-to-year tax saving through negative gearing. The negative part means that it's still costing you money to hold the investment even after the tax concessions. So you should look at what you think the market will grow at and aim for growth that at least covers the after-tax loss you have incurred in holding the asset. There are circumstances where you can increase the tax loss without anything more coming out of your pocket. This is usually achieved through depreciation, where you write down the cost base of the asset each year. Generally, this works best with new properties, and we strongly recommend that you obtain a quantity surveyor's report to give you the full details of what you can claim. In most cases, there will be capital gains tax to pay when you sell the investment. This is whether you invest in property, shares, or managed funds. If you've claimed depreciation whilst you've held the asset, keep in mind that this reduces your cost base, meaning that you're likely to have a larger gain than you might think. If you repay your loan on principal and interest basis, you will be making principal repayments. These amounts are not tax deductible, so bear in mind that the cash required to hold the investment will likely be higher than the net tax loss. So what should you do next, and how do you know if it's right for you? As with any big decision, it's important that you seek professional advice. If you found a property or are considering negative gearing, we suggest that you ask your accountant or advisor to prepare a rental analysis for you. In doing so, they should be able to help you fully understand both the purchase and ongoing costs of holding the property, even after the tax concessions. And of course, if you do have any additional questions, please feel free to contact our office.